This lecture focuses on branch-level taxes, which are branch profits tax, branch interest taxes, and tax on excess interest relating to the unincorporated U.S. trade or business of a foreign corporation. The objective of this lecture is to provide a brief overview of the following: foreign corporations that may be subject to branch-level taxes, branch profits tax imposed on the foreign corporation, tax on branch interest received, tax on excess interest imposed on the foreign corporation, and the impact of U.S. tax treaties on branch-level taxes. Here's an overview of the scope of the branch-level tax rules. Section 884 provides for the branch-level tax rules, which include the branch profits tax, the tax on branch interest received, and the tax on excess interest. These rules apply only when a foreign corporation owns and operates an unincorporated U.S. trade or business. The rules do not apply when a foreign corporation owns a U.S. domestic corporate subsidiary that operates a U.S. trade or business. And the rules do not apply when a foreign individual or foreign non-corporate entity does business in the United States through a non-corporate entity. The first tax we look at is the branch profits tax. The branch profits tax, or BPT, imposed by Section 884A, is a 30% tax on a foreign corporation's dividend equivalent amount, or DEA, for the tax year. As discussed later, if a treaty applies, the branch profits tax can be reduced or eliminated. The BPT is a tax on the foreign corporation that is in addition to any regular U.S. tax paid by the corporation on its U.S. taxable income. Here's an example. Foreign Corp is a foreign corporation that does business in the United States through an unincorporated branch office. During the year, its U.S. taxable income is $100x, and it pays U.S. federal income tax of $21x. Assume that its dividend equivalent amount, or DEA, is also $100x. Under Section 884A, BPT will be imposed at a rate of 30% on this amount, resulting in a BPT of $30x. Total tax for the year is $51x, the regular tax plus the branch profits tax. However, assume a treaty applies, and the rate of branch profits tax under the treaty is 10%. In this case, the branch profits tax is $10x, and the total tax is $31x. Only the dividend equivalent amount, DEA, is subject to the branch profits tax. So what is the DEA? The dividend equivalent amount is the amount of profit deemed withdrawn from the U.S. branch. The DEA is determined by comparing the earnings of the branch for the year to the change in U.S. net equity for the year. Simplistically, if the U.S. net equity increases by the full amount of the earnings for the year, then there is no DEA, since none of the profits are deemed to have been removed. The DEA is calculated as follows. The foreign corporation's effectively connected earnings for the year, reduced by the amount of the increase in net equity during the year and increased by the decrease in the U.S. net equity for the year. Here's an example. Foreign Corp operates a U.S. traded business that has U.S. net equity of $1,000 at the beginning of the year and at the end of the year. That is, in this case, U.S. net equity has not changed. The U.S. trader business has effectively connected U.S. profits for the year of $100. If Foreign Corp had reinvested all of its U.S. profits during the year in the U.S. traded business, it would have had U.S. net equity at the end of the year of $1,100. Because its U.S. net equity did not change, under the formula, Foreign Corp is deemed to have removed the profits from the U.S. trader business. For practical purposes, the U.S. trader business is treated as if it had paid a dividend to Foreign Corp. Thus, the profits become a DEA subject to the branch profits tax. If, on the other hand, U.S. net equity had increased to $1,100, Foreign Corp would be deemed to have reinvested its U.S. profits in the U.S. trader business, and there would be no DEA. The following example illustrates the purpose of the branch profits tax. This example illustrates the manner in which the branch profits tax can be the equivalent of the tax that would be paid by a foreign corporation on the receipt of a dividend from a U.S. corporation. Foreign Corp is a Country X corporation which owns several retail stores in the United States. The stores constitute a U.S. trader business. Assume that in 2020, the U.S. business has profits of $500 and U.S. net equity increases during the year by $100 as of the end of 2020. This means that 400x of the profits were withdrawn from the business. This 400x withdrawal is subject to branch profits tax as a dividend equivalent amount at 30% for a tax of $120x. If the same U.S. business was owned by a U.S. corporation and $400x was withdrawn from that corporation and paid to Foreign Corp as a dividend, that distribution would be subject to tax of $120x. This example illustrates how the branch profits tax attempts to place a foreign-owned U.S. traded business operated as a U.S. branch in the same tax position as a U.S. traded business operated as a U.S. corporation. Let's look at some other aspects of the branch profits tax rules. The presentation so far is a brief sketch of the basic rules. The code and the regulations go into great detail regarding the mechanics of these rules. They cover the definition of U.S. net equity, which is U.S. assets less U.S. liabilities, both of which are defined by Section 884 and its regulations. Earnings used in the DEA calculation, which are earnings and profits that are effectively connected with the conduct of a U.S. trader business. The effect on the branch profits tax of the termination of a U.S. business, the incorporation of that business, or the liquidation or reorganization of the foreign corporation that owns the U.S. trader business. And rules for determining if a foreign corporation qualifies for the benefits of a tax treaty. Now let's turn to the special tax rules for branch interest. Branch interest is interest that is paid by a foreign corporation with respect to a liability that is considered a liability of a U.S. trade or business. Branch interest is treated as interest paid by a U.S. domestic corporation. The purpose of the branch interest tax is to impose the same tax on a payment of interest by a foreign corporation with respect to the debt of an unincorporated U.S. business as would be imposed on the same payment made by a foreign-owned U.S. corporation. Absent this rule, interest paid by a foreign corporation would be treated as foreign source income since, in general, only interest from a domestic corporation is treated as U.S. source. Where a treaty applies, a foreign person that receives branch interest is entitled to claim any available benefits under the treaty, including a reduction of the rate of tax on the interest. Here's an example of the special branch interest rule. Foreign Corp operates a U.S. trade or business which borrows $1,000 from N, a non-resident alien individual, and uses the funds for working capital of the U.S. trade or business. Assume that the borrowing is considered a liability of the U.S. trade or business. During the year, Foreign Corp pays $50 of interest to N, and under the normal rules of IRC 861A1, the interest income to N would not be U.S. source income because it is not paid by a U.S. corporation. However, under the special branch interest rule, the interest is treated as paid by a U.S. corporation and therefore considered U.S. source income subject to U.S. tax and withholding. Now let us turn to the tax on excess interest. A foreign corporation is taxed at 30% on excess interest unless a lower treaty rate applies. For this purpose, excess interest equals the interest allocated to and deducted by a foreign-owned non-corporate U.S. trade or business less the branch interest of that U.S. trade or business as described in the previous discussion. Here is an example of the calculation. Foreign Corp operates a U.S. trade or business as an unincorporated business. Interest expense of $100 is allocated to and deducted by that U.S. trade or business. This amount is deducted in determining its income subject to U.S. tax. Of this amount, only $70 is considered branch interest paid by the U.S. trade or business. Because its branch interest of $70 is less than its allocated interest of $100, it has $30 of excess interest. This $30 represents a portion of the total interest of the U.S. trade or business that is not U.S. booked interest of the U.S. trade or business. It is interest paid on liabilities recorded on the books of Foreign Corp that is allocated to the U.S. trade or business. Foreign Corp is treated as receiving payment of this interest on the last day of the tax year and is taxed at 30% on this amount unless a lower treaty rate applies.